Kris, fabulous to see you. Thanks so much for being on the podcast. Why don't you start, if you would please, with a brief self-introduction. What's your name, company name, and position?
Sure, Adam. Thanks for having me. My name is Kris Benson. I'm the Chief Investment Officer for Reliant Real Estate Management.
Right. And so tell me about the company, because Reliant Real Estate doesn't tell me what business you're in. Tell me about the company. When was it formed? Brief background.
For sure. So Reliant Real Estate Management is a vertically integrated self-storage operator. So that means we are buying and managing the self-storage properties we buy. We're located in Roswell, Georgia, which is just north of Atlanta. We're about 20 miles north of Atlanta. And Adam, Reliant was originally formed back in 2009, but we actually bought our first self-storage property in 2007 under a different entity. And we've been buying and selling ever since. And so today we have 50 properties in the portfolio, just over 4 million net rentable square feet. That equates itself to about 31,000 units, and they are primarily spread across the southeastern part of the U.S. So Florida, Georgia, North and South Carolina, Tennessee, Alabama. We have a little portfolio out in Colorado, but primarily the bulk of our portfolio is right there in the southeast.
And what is the dollar value currently of your portfolio, and historically, how much have you transacted?
Yeah, I would say in the last 5 years, we've probably done in excess of $750 million of transactions, both buying and selling. The value of our current portfolio, I think, would be a topic of great debate, depending on which cap rates we would apply to the current NOI in our portfolio. You know, I would say it's somewhere in the neighborhood of $400 to $700 million. Again, depending on who you ask and at what time of the day you ask them.
And what is the average hold, historically, what has been the average hold time for your deals?
You're saying, for the ones that we've sold?
The full cycle ones, yeah.
Yeah, so we've sold 38 properties, and on those 38 properties, our average hold time is just over 3.5 years.
And you've taken private investors or individual investors throughout the course of your history. What's the typical return profile look like for those investors?
Yeah, you're correct. So most of our offerings, Adam, are for our accredited investors, and the majority of the equity rate we raise comes from those investors. It depends a little bit on the deal, for sure, when we think about a return profile. But generally, I would say in our current fund, for example, that return profile is going to be in that mid-teens annual return. So let's use a $100,000 investment. If you were to invest $100,000 into a Reliant project, our hold period projected is usually 6 years. And we're going to return somewhere in the neighborhood of 172 to 190,000 to you over that 6-year period. So that equates to about a 12 to 15% a year return.
Right, and that includes regular dividends and capital gains.
You're 100% correct. So we make distributions on a quarterly basis. So you would be earning distributions every quarter, assuming the properties perform well. And then that would also include the profit from sale at the disposition of the property.
All right, let's talk about investment strategy. What do you invest in, right? Specifically, what types of self-storage?
Yeah, it's a great question. So we've done all there is to do in storage, right? You could do a ground up development where you're buying a piece of dirt and building a facility. And we've done a little of that, but we're certainly not a developer. We've done what we would call retrofits of retail self-storage or retail dark boxes, meaning you take an old Kmart or a Toys R Us and it's empty and you build out a self-storage facility in there. We've done that as well. But our sweet spot really has been value add deals in smaller markets. And we refer to those as secondary and tertiary markets. And value add, Adam, for many people, they think about apartments, where they go in and put in hardwood floors and granite countertops and stainless steel appliances and then just charge more rent. Well, we rent garages, so we can't really do that. So that value add strategy is really specific to each property that we do. Sometimes that value add strategy is we'll build out some additional square footage, and then the growth is coming from getting those units leased up. Sometimes the value add is more of a management play where the current operator is not doing a good job maximizing revenues around some ancillary income items. Things like maybe they don't do U-Haul truck rental, or tenant insurance or retail sales, boxes, locks, moving supplies. And many times we'll plug that in from our operational platform to the facility and be able to grow revenue that way. So I would say that generally we do a little of everything, but our sweet spot really is value add deals in tertiary markets.
Yeah, and it's a highly fragmented industry, isn't it? Tell me something about what the kind of the general landscape looks like and where you see opportunity in that.
Yeah, you're 100% correct. Storage is interesting in that there are 6 publicly traded companies. 5 of those are REITs, and those are brands that your listeners, Adam, are probably seeing as they're driving down the highway right now. CubeSmart, Extra Space, Public Storage. U-Haul, which is not a REIT but publicly traded company, has their own storage portfolio. So those 6 companies make up about 30% of the net rentable square footage in the US in self-storage, right? So 30% is attributed to those 6 big players. The rest of the market is very fragmented. So meaning the ownership of the remaining 70% of square footage, it can be groups like Reliant, regional operators. It can be small mom and pop owners. So maybe my dad built a facility 30 years ago and we own one. But what that allows for us from an opportunity standpoint is really a consolidation or a roll-up strategy. The opportunity to take all these little mom and pops and roll them up into one portfolio. And really that's what we see as the long-term play in the asset class.
And that's an economies of scale play, is it, from a management perspective and standardization across these disparate locations?
Yeah, it's 2 things. It's that, right? So we can plug in we can get cheaper digital marketing because we have other assets in that area, right? We can share employees so we can reduce payroll. Some of the operational efficiencies like you're describing. But the second piece of this is in the environment we live in today, there is very much a premium for larger transactions within self-storage. So institutional capital is trying to get into the asset class, but it's very challenging because the deal size is small. So, and I say small for many of our listeners, I say $5 million of equity and they say that's a lot of money. It is. But if I run a $150 billion fund, $5 million doesn't move the needle. $50 million doesn't move the needle. $1 billion moves the needle. And it's really hard to take that $1 billion and deploy it into $5 million checks each. So what's really created value in the marketplace, Adam, is being able to take a large portfolio out where big groups like a Blackstone or KKR or Apollo, the groups that people have heard of, can deploy a big check. They're interested. And so they've really pushed the prices up on those larger transactions.
So is that part of the Reliance strategy, is to build a portfolio that could be exited, could be sold to a major REIT or one of the major players?
Yeah, so of those 38 properties we've sold, 80% of those have been sold to REITs or institutional capital, right? Those are kind of the buckets that are buying. I would say that larger roll-up strategy, maybe we take 100 properties out. That's in the back of our minds for sure. Not to say we wouldn't sell properties individually along the way, but there's value in this portfolio level transaction. So we're certainly evaluating that as we build out the business.
Kris, I have a personal question for you about self-storage. You come from a very, very sexy industry, right? The Da Vinci robot. I mean, just the name conjures up incredible images. It's like brain surgery, seriously. And now here you are in one of the least sexy real estate asset classes. Why do you like self-storage?
Yeah, so, well, not to get too much into the background side of it, but for me, I've always loved real estate. I love tangible assets, right? I love things that I can touch and feel. And real estate is very black and white in how they get valued. So I've always invested in real estate, and that's been my kind of side hustle when I did work for Intuitive Surgical. But, specific to self-storage, Adam, what's so interesting about it, you're right, it's a garage, right? And in its basic form, it's a heated garage or it's not. That's it. There's no magic, right? It's a cement pad with corrugated metal and some steel beams. But when you think about the industry, what's so fascinating is historically, it's outperformed all the major asset classes in the last 25 years: apartments, office, retail, the sexy real estate plays. But not only has it outperformed from a historical level, it's also got downside protection. And we're recording this in the middle of COVID, right? In April of 2021. Last year, 2020, self-storage has absolutely crushed it, right? And that also happened in 2007, 8, 9, where some of the other industries, office, retail, hospitality, got crushed. In 2007, 8, 9, storage did very well. And through COVID, the same thing is happening. And I think that's rooted in the idea of when people are in transition of their lives, we talk about the 4 Ds of self-storage: death, dislocation, downsizing, and divorce. When those things are happening in your life, you generally need the asset class. And fortunately for us, unfortunately for the general population, the pandemic has created more of all of that. So back to the me question, I love opportunities where you have upside and then you have this downside protection. And then the third thing, we talked about it already, is there's that consolidation opportunity and some real runway in the asset class to grow. So that was the reason I originally made the switch to self-storage.
So this podcast is a corporate overview. However, I do want to know a little bit about some of the key drivers of the self-storage business. And I wrote some down. One is, just talk to me about, I'll go through them quickly, but one is traffic count. I noticed that in all of your stuff is traffic count. Why is traffic count important to self-storage business?
Yeah, it's a great question. So look, eyeballs matter, right? Especially in self-storage, because it's a very micro market game. When you think about what we just said, it's a garage. So it has to be convenient for either work or home. If it's not convenient, you're not going to travel for self-storage, right? You're just going to go to the one that's closest to your house. So what's really important is that you're getting eyeballs every day. And when someone needs self-storage, they think, oh yeah, I pass that one on the way to work every day. Midgard self-storage is right there. I'm going to Google it. And then they Google it, and then they can rent a unit or they come in the office. And so generally, we're looking for a traffic count of at least 10,000 cars a day. Sometimes that number, if you're on a major highway, you're talking about 40, 50,000 cars. On a major interstate, that might be, a 6-digit type of number. But we're just looking for eyeballs. About 30% of our traffic usually comes from drive-by or is initiated by drive-by. They see it, then they get on their phones and Google Midgard self-storage, and then they look up pricing, set an appointment, maybe they book their lease. So it's a critical piece that we want to make sure we're in the eyes of our consumers every day.
That's very interesting. So traffic count trumps population within a certain area, does it? Within a radius of a property?
I don't know if it's trumping it, Adam, but it's certainly a relevant factor, right? If you're in a great population center, that's usually going to win, even if your exposure to the traffic count may be a little bit less. If you're tucked away, maybe in an industrial center or something along those lines. If the market is growing like a weed, that's always going to be a great indicator. But when we look at a market, Adam, think of it this way: it's very market specific. So the only thing that matters is the 1, 3, and 5 mile radius around the facility. And sometimes in a rural market, maybe we look at 7 to 10. But the idea is people aren't going to travel. So your bucket of consumers lives in that world. And so you want to understand what's happening in that world and how you fit in. And so our acquisitions team always talks about the story in the market, right? It's not just one metric. It's not just population or income or traffic count or, supply of competitors. It's all of those things come together. What is the story? What's happening? I'll give you an example. In self-storage, people talk about this the supply number. So there's a metric that determines over or under supply in self-storage, allegedly. So in the Southeast, we use a number of 7 square feet per person. So what that means, Adam, if you look at a 5 mile radius, right, and there's 100,000 people in that 5 mile, you multiply that by 7, there should be 700,000 square feet of storage to service that people. That's equilibrium. And if you look at the market and let's say there's 1 million square feet of self-storage, well, then it's oversupplied. Or if there's 500,000 square feet of self-storage, it's undersupplied. But it doesn't tell the whole story, right? It's one metric. So, you look at that metric and then overlay, okay, well, let's say there's 1 million square feet of supply. So you're oversupplied, but every facility in the 5-mile radius is 95% full. Well, then there's more demand than that 7 square feet per person. So again, our acquisitions team does a really good job of saying, look, it's not one metric. It's you layer metrics on top of each other to come in with a story on the market.
That's absolutely fascinating. And actually, it reminds me of when I built movie theaters in Japan, like everybody does. Right?
Sure.
And we looked at a number of people per screen in a market. It was like picking up money in the street. See, I think it was 10,000 per screen, and in Japan it was 100,000. So we could build anywhere. So what are Reliance? Let's just go through a few kind of a quick SWOT analysis. What are Reliance strengths?
Track record. It's two things. I mean, if we're thinking of this from an investor side of things, I've done a lot of passive investing over the years, and you're really investing in two things: track record and team, right? It's the people who make the investment work. And I would say, close behind 1A is our team. We got a great team of people who have an extraordinary knowledge of the asset class and an intimate understanding of what makes this work. So, number 1 and 1A are pretty closely related, but we've had a fantastic historical track record, and we got a great team that we think will continue that moving forward.
Okay, so what are the weaknesses of the company? What are your challenges?
Yeah, I mean, I think it's twofold. It's we are still small relatively to those 6 publicly traded companies. To give you a sense of scale, the number 1 self-storage REIT in the country is Public Storage. They have 2,300 properties across the world. We have 50, right? So it's a pretty diverse set. And, with those operational efficiencies, there are some things that we can't do that they can, right? They can outspend us in digital advertising, always. We will never have the digital advertising budget that they will. So those are things that just in pure scale, but we can be much more nimble than they can, right? And that's where we can create some wins in those markets. But it's also the reason, Adam, we're really interested in the tertiary markets is because we're not competing against the Public Storage, the Extra Space, and CubeSmarts, right? We're competing against Bob's self-storage. I apologize, Bob, if you're on the podcast, but we're competing against mom and pop operators where our professional management prowess allows us to perform at a much higher level.
What is your secret sauce that makes you different than all the other self-storage operators of your scale?
I mean, again, I would go back to team, right? We got a great team, but I think the execution of what our strategy is, which is really built around this value add play in tertiary markets. That's where we've been able to outperform over the years. And we think that's where the outperformance will come in the future as well. There aren't a lot of people going into, Midland, North Carolina to build out an additional 20,000 square feet at a facility, right? Because it's a smaller market. It's 16 miles east of Charlotte. Nobody knows where it is. It doesn't look good on paper, but when you dig into that market, they become really interesting. So I would say our ability to be opportunistic and look at everything with the lens of where is the value add play here is really what gives us that competitive advantage.
And what puts you on the back foot, if you like, on the defensive? What are the threats to your expansion strategy?
Yeah, I think as an asset class, Adam, the biggest is new supply being delivered. So anytime in real estate an asset class performs well, we talked about it, right? Historically, it's done well. It's got downside protection. Well, when people see that, other people are going to get in the game. And so there's been, if you look at construction spending since 2013 to 2020, the chart looks like a hockey stick, right? Because there's been a lot of groups entering the space trying to take advantage of what we just described. And so new supply was really the biggest risk pre-COVID, and then COVID hit and everyone was like, oh my God, what is going to happen? But then post-COVID, as it sort of settled out, we said, okay, people are still going to consume self-storage. Then secondarily, it's back to the same issue, is new supply coming to market. It's basic economics, right? If supply is really high, prices drop, right? So we've been fortunate that even in markets where we've gotten impacted with new supply, once everybody gets stabilized on the occupancy side, prices come back. But during that lease up period for people, there's some pain there because prices are much lower than you would have expected them to be. So that's what kind of keeps us up at night when we look at new markets, is how could this get impacted by new development?
Let's wrap up with two questions specifically about you. What has been the hardest lesson you have learned in real estate?
Patience. Patience. Look, someone, and I wish I could give credit to who said it, but time is the best investment vehicle, right? And Warren Buffett talks about this, right? I mean, arguably, if you subscribe to his thought processes, is compounding and time are the most powerful vehicle ever. And me personally, I'm not necessarily a very patient human being. And real estate has really given me a longer view of the horizon for us as an investment. But me, when issues happen, it's very hard to get enveloped, or very hard not to get enveloped in that one specific issue. And over time, it starts to flatten out. So, I think patience is one thing that it took me, and I'm still working on it, but it took me plenty of time to get comfortable with being patient.
Yes, that's a fascinating insight. So let me ask you the last question. What gets you up in the morning? And I don't mean coffee. What makes you excited about starting the day?
Yeah, I mean, look, besides the personal things that I have my own personal motivations, I think from the business side of things, it's the opportunity that we see every day in Reliant from a growth standpoint. There's really a unique opportunity in the asset class that doesn't come along very often. And that's what we're excited about, to partner, not only with our investors, but internally with the team here to continue to grow it.
Kris Benson, enormous pleasure. Thank you so much for being on my podcast today.
My pleasure. Happy to do it.